You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. All right, last week we did a strategy around Netflix before earnings, and that's mainly because we had a successful butterfly that we did 2 weeks ago in United Healthcare. We had more of the same with the Netflix trade. Netflix was looking to announce earnings on Monday. We thought we would do a fairly wide butterfly in Netflix and just hope that we'd get one day where the market would kind of stay neutral on Netflix, and that would allow us to get out of the butterfly at a positive trade. So just looking at the charts on Netflix, we placed the trade on a Wednesday of last week. So last week it was the 11th of April. And on the 11th of April, we did a butterfly that was 15 points wide. And we were looking at buying the 287.50s. Our center strike was the 302.50 strike. And then we went 15 points higher from that and bought another 317.50 strike. So bottom line is we needed the stock to stay somewhere around 302 for the day. And what happened? Well, the market opened on Thursday, the 12th, and it really did nothing. On Thursday the 12th, the open was 309.72, which was still within our range. And the low for the day was 302.75, and the high was 311.13. So once again, it did absolutely nothing, and we got what we wanted, 1 day's worth of time decay in our butterfly, and that trade should have once again been profitable. And if you got the stupid award and hung around until that Friday, the 13th, right? Friday the 13th. Well, if you did, you still did okay, but you really shouldn't have hung around. On Friday the 13th, I think it got up to our high, our protective strike, which was the 317.49. That's actually the very high of the day. On the low, it was at 308.23, and it closed at 311. So even if you stuck around until Friday, you still should have did very well on the trade overall. It was a 15-point wide butterfly, 30-point range that it could stay in. So we had two butterflies that we put together on fairly expensive stocks. Outside of earnings, ignoring the earnings and trying to take a benefit of a huge rate of time decay on the fact that you have expensive underlyings just in general, and the market's been volatile recently. Okay, so now let's get back into earnings. We have the FANG stocks in full force next week. We have Google, we have Amazon, we have Facebook. As a matter of fact, in order, Google's going to announce first, then Facebook, then Amazon. And so I'm going to look at the first trade, or the first FANG stock, Alphabet, I should say, or Google, and we're going to look at doing a skip strike butterfly on Google. Now, we're going to go way out in time, and one of the things that I don't like as much about the Google trade that we're going to look at, I guess I'm starting with a downside, is that they're announcing on Monday, and there's going to be a lot of premium in this underlying. So we're going to go as far out as possible on this butterfly and really hope that Google doesn't make the expected move, that we're going to go as far out in our strikes and set up a skip strike butterfly that we can actually put this entire butterfly on for a net credit to the account. So right now we are taping Options Playbook Radio, and it is April 18th, and the markets are closed. Google closed at 1,075.39. It was down $3.97. So 1,075.39. And it was down $3.97. If we look at the nearest at-the-money straddle for Google, that will give us the expected move. And right now we're showing that expiration is April 27th. There are 9 days away. The move on that is looking to be $56, but we still got a lot of time until that expiration date, but keep that in mind. The implied volatility is trading at about 40% implied volatility. So we're going to go out at least the 55 points, right? That's the expected move. We're going to do it on the call side, and you could do it on the put side. You can just flip a coin on this. I prefer to stick when I'm doing skip strikes on the call side, because just in general, stocks usually don't go up as fast as they go down. I mean, that might just be in theory. Sometimes recently the stocks have moved just as much to the upside as they have to the downside, but we're going to stick with that theme. So to start off with, what we're going to do is, if we take 55 and we add it to the current price of 1,075, that's going to put us at, well, let me do that math there. So 55 plus 1,075 puts us at 1,130. And we're going to probably want to go much higher than that. I'm going to probably say another 20 points higher. And we're going to add 20 points to that. So our range, or where we're going to start looking to do the skip strike butterfly, is about the 1,150 strike. Is if we can even move a little more than that, if we can get farther up, that's just about where we're going to start, and we can get this trade done for a net credit, that's going to be our goal in this scenario. So if I start edging up and I look at buying the nearest term expiration on this, that would contain that earnings. And that expiration would be the 27th of April. And we look to buy the 1,150 strike call and sell 2 of the 1,170 strike calls, 20 points higher. And then we're going to skip a strike. So in this scenario, we're going to go 40 points. A normal butterfly would be 20, so we add 40 onto the middle strike, 1,170, and we're going to look at the 1,210 strike call. So once again, we're buying the 1,150, selling the 1,170, buying the 1,210. It's a 20-point wide butterfly, but we're embedding a credit spread in this butterfly to help pay for the butterfly. We can get this entire trade done for a net credit of 35 cents to the account. And our maximum risk is from the skipped strike, which is 1,190, to the protective strike, which is the 1,210. So that's 20 points. So 20 points minus the small credit brought in, which we're not too worried about there, is, it's not helping us out too much, is $19.65. Now that's our max risk if by that Friday expiration, Google has gone up almost double the expected move. More than double, actually, in this scenario. So it would be, the expected move is 55 points. So you're talking about 110 points plus 1,075 is a 1,185 point move. That's where we would need the market to go. Over 110 points, all the way up to 1,185. So we're looking for double the expected move in order for us to really reach our max risk by that expiration date. So what's the ideal scenario here? The perfect scenario, and I'll tell you what that is, and we'd never expect to get the perfect scenario. And as always, nothing's meant to be recommendations here. We're just trying to learn on Options Playbook Radio. But the perfect scenario would be that the market would open up just shy of the 1,150 mark, basically make almost the full move. But if it does it right away, that forces our hand. We'd have to get out of the trade, and there's still a lot of premium. And I'm going to emphasize the fact that they announce on Monday and these expire on Friday. I'd much rather have them announce on Wednesday. And a lot of times Google used to announce on Thursday right alongside of Amazon most of the time. But for some reason they chose that it was going to be Monday this week. So I would like it to open in the 1,150 or 1,140 point range and slowly drift up towards the 170 and say right at expiration it goes out at 1,170. That would be the perfect scenario. Now, that's not what we're looking to do on this trade. We do have, almost $2,000 worth of risk per 1x1, per 1x2x1 butterfly. So we keep that in mind when we're doing this trade because we're dealing with a high price stock. If we're dead wrong, the market goes straight down. We can make that 35 cents. So we're basically just putting this trade on for nothing. If the market goes down, we get our commissions back. We make a small profit. Not a big deal. Our main goal on the upside is we still got a 20-point wide butterfly. So we got 2,000 points worth of risk. That means we got 2,000 points worth of upside in a skip strike scenario, in a perfect skip strike where it's 20 by 40, where we're doubling the hedge from the one that we're actually purchasing. So in that instance, if we could sell this for 5 or we could sell this for 7 or 8 or 9, we're just going to get out of it. We're not going to stick around. There's just too much risk in this underlying. So I'm looking to be out of this trade by Tuesday or Wednesday. Hopefully it's only a one-day trade. Now, it's obviously the way that it plays out. If the market, let's say the market just does nothing, it opens at 1,075, you might as well stick around. You might as well just stick around and see if it starts creeping forward. That actually isn't a bad scenario, that the market opens flat after earnings, which is almost impossible, but the market opens flat because you still got a chance that it can make it up to your skip strike for the week, up to your short strike for the week. So not a bad scenario there. So we're looking at doing a skip strike call butterfly in Google. If we put it on tomorrow, we would expect to get somewhere around a 35-cent credit. We're looking at the April 27th expiration, and we're going to be buying the 1,150 strike call, selling 2 of the 1,170 strike calls, and buying 1 of the 1,210 strike calls. All done for a net credit of 35 cents, 20-point wide. Your margin requirement is $19.65 or $1,965 per 1x2x1 butterfly. All right, well, let's come back next week and we'll look at this trade and see how it's done. By the show next week, we should have a real good feel for where it's at. And Facebook will be announcing next week on Wednesday after the close. So we'll probably look at that trade. Thanks for coming, everyone. And that's it for this episode of Options Playbook Radio. If you have a topic you'd like to discuss on the show or a question you'd like us to answer on the program, you can send them directly to me at theoptionsguy@invest.ally.com. That's theoptionsguy@invest.ally.com. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.